Welcome to the Deep Dive. We cut through the noise to get you the key insights from important corporate earnings calls.
And today, we're digging into Constellation Energy Corporation, that's CEG. Their Q3 2025 call was on November 7th.
Right. And this one was pretty interesting, kind of a mixed bag on the surface, wouldn't you say?
Definitely. The headline financials looked, well, okay, a slight miss on earnings, but the market seemed to just, brush it off.
Why is that?
Because the real story, the one investors clearly bought into, was all about execution. Stellar operations, especially with their nuclear fleet, and the bigger picture, CEG positioning itself as the power source for the whole data economy boom.
Okay, let's break down those numbers first because that contrast is key. The adjusted EPS, earnings per share, was $3.04.
Yep, and the consensus was looking for $3.11, so a small miss there.
But then you look at revenue.
Exactly. Revenue came in at $6.57 billion. That smashed the consensus estimate of $6.2 billion, a really significant beat.
So miss on earnings, beat on revenue. How does that happen when the operations were supposedly so good?
Well, that's where the operational deep dive comes in. The strength there really explains why the market looked past the EPS number.
Let's get into that. The nuclear generation numbers looked solid, up 2.1% year over year.
They did. But the standout metric, I think, has to be the capacity factor for the main nuclear fleet, excluding their shares in Salem and STP.
What was that number?
An incredible 96.8%. Just think about that. Running nearly flat out all the time. Last year, it was 95.0%.
Wow. That kind of reliability is exactly what big tech customers need, right?
Yeah.
2047 power.
Precisely. It's the core of their value proposition. You can't get that from intermittent renewables alone. Plus, they did this while actually reducing planned refueling outage days.
Fewer days offline means more generation, more revenue.
Yeah, only 23 outage days this year compared to 37 last year. That's just pure operational efficiency translating to the bottom line. Or, well, the top line mostly.
And you saw management's confidence reflecting this in the guidance update, didn't you?
Absolutely. They tightened up the full year 2025 adjusted EPS guidance. The new range is $9.05 to $9.45.
It was $8.90 and $9.60 before.
Correct. So they narrowed the band and, crucially, nudged the low end up. That typically signals strong belief they can hit those numbers, that the second half is looking good.
Okay, let's circle back to that EPS miss, though. If operations were, as they put it, outstanding, what actually caused the drag?
Right. It's a bit counterintuitive. Management pointed to really strong gross margins and great performance from generation and commercial teams. That was the upside.
But something offset it.
Yeah. O&M costs, operating and maintenance, those came in higher than expected.
And the reason was?
Stock compensation. Which sounds maybe a bit dry, but the reason for the higher stock comp expense is pretty wild.
Go on.
It's because CEG's stock price has just gone absolutely parabolic. It was up over 50% year to date when they had the call.
So when the stock does incredibly well, the cost of paying out those stock-based incentives goes up.
Exactly. It costs them more real dollars, effectively, to fulfill those compensation plans. So, ironically, their amazing stock performance created an earnings headwind. It's what you might call a high-quality problem.
Definitely a better problem than the alternative.
Right.
Was there anything else impacting earnings?
They did mention getting capacity revenue from the PJM auction, which is good, but that was partly offset by lower revenue from the nuclear production tax credits, the PTCs.
Okay, hold on. PTCs. Why would running the plants better mean less tax credit? That seems backwards.
It does, yeah. It's a quirk of how the PTC is structured. It's designed to incentivize clean generation, but it works within a certain revenue zone or band.
So if you make too much money per megawatt hour,
you could actually phase out of the credit. Because CEG's plants were running so efficiently and market power prices were supportive, they were operating near or even sometimes above the top end of that PTC zone.
So again, excellent operational performance leading to a slight negative variance on one specific line item, but driving much higher overall profitability.
Precisely. Strong execution is the engine here. And that financial strength underpins their big strategic moves, like that massive Calpine acquisition. $26.6 billion. What's the latest on that?
Still moving forward. They reiterated it's on track to close in the fourth quarter. The last major hurdle is the Department of Justice approval.
Okay. And they need to sell some assets as part of that deal, right? For regulatory reasons.
They do. And management's commentary on that was quite interesting. They sounded pretty relaxed about it.
Relaxed how?
He said they were comfortable delaying the asset sale process a bit if needed. They want to make sure they sell, and I quote, the exact right assets.
That suggests they feel they have leverage, that the market for those assets is strong, and they don't need to rush into a fire sale. They can optimize.
That's how it sounds. Very confident posture.
Yeah.
And looking post-close, this combined company is going to be a powerhouse.
Absolutely. They highlighted having $14 billion in liquidity once Calpine is integrated, all backed by an investment-grade rating.
And they laid out capital priorities pretty clearly, too.
Yeah, very clear roadmap. Number one, keep that strong balance sheet, aiming to get back to their target credit metrics by the end of 2027.
Okay.
Number two, deliver at least 10% annual dividend growth. Good news for income investors.
And number three,
finish the current share buyback program. There's about $600 million left on that. So discipline, returning cash, but keeping the balance sheet healthy.
all right, let's pivot to the really big theme.
Yeah.
The connection between nuclear power and the data economy. The hyperscalers, Meta, Microsoft, Google, etc.
This is where management got really animated on the call. They said the market for data center power is hotter now than ever. That's a direct quote.
And it's not just demand, it's the type of demand, right?
Exactly. They describe the buyers now as far more sophisticated and aggressive. These companies understand power markets, they know what reliability costs, and crucially, they want nuclear. They need massive amounts of clean, 247 power, and nuclear is basically the only game in town for that at scale.
Constellation was also very specific about the kind of deals they're chasing. Exclusively front of the meter. Can you unpack that for us? Why is that distinction important?
Sure. Front of the meter means they sell power directly onto the main power grid. The utility transmission and distribution system delivers it. This is different from a behind-the-meter setup where, say, a factory might have solar panels on its roof supplying power directly to itself.
So why focus only on front of the meter for these huge data center deals?
Because it plays to Constellation's strength.
Yeah.
They leverage their existing massive, highly reliable nuclear plants and the established grid infrastructure. They sell a premium product that reliable carbon-free power into the system, capturing its full value, including capacity payments in organized markets like PJM. They're not trying to build bespoke microgrids for every customer.
Makes sense. Sell your best product using the most efficient channel. But if these big, sophisticated buyers are lining up, what's holding things back? What's the bottleneck?
One word: interconnection. Getting these gigantic new loads physically and regulatorily connected to the grid. Management was crystal clear that this is the main gating function.
That sounds like a big problem. It's a technical issue, a regulatory one.
It's often a combination. It involves the transmission utilities, planning processes, regulatory approvals, and just the physical work of building new substations and lines. It takes time.
So not entirely in Constellation's control.
Not entirely, no. Which is why they sounded genuinely encouraged by recent policy signals. They specifically mention a letter from the Secretary of Energy pushing FERC, the Federal Energy Regulatory Commission, to start rulemaking aimed at standardizing and speeding up the connection process for large loads.
So top-down support to clear that bottleneck.
Exactly. They see it as the government recognizing the need to enable the infrastructure for AI and the data economy.
Beyond the deals themselves, another asset that came up was the land, the actual sites where these nuclear plants sit.
Yeah, this is a really undervalued aspect, I think. Management emphasized that these existing nuclear sites with the land, the cooling water access, the transmission links, the security, the skilled workforce, the community relationships are incredibly valuable and almost impossible to replicate from scratch today.
Decades of work and investment just to get the site operational and accepted.
Precisely. They basically view these sites as the prime real estate for the next generation of nuclear, whether that's advanced reactors or small modular reactors, SMRs. If you want to build new nuclear in the U.S., starting at an existing nuclear site is likely the fastest, maybe the only path in many places.
But they aren't just waiting for SMRs. They have growth plans within the current fleet, too. Uprates.
Right. Highly economic uprates. They've identified another 900 to 1,000 megawatts of potential capacity increases across their existing reactors. They mentioned Limerick and Calvert Cliff specifically.
And the economics are good because...
Because you get more output, significantly more. Often without needing any more staff or even any extra nuclear fuel, you're just tweaking the system to run it slightly harder, more efficiently. It's very high margin, low risk growth.
They also flagged some wins On the state regulatory front, which is always important for a utility owner, Maryland, for example.
Yeah, resolving the long-standing issues around the Conowingo Dam's water quality certification was a big deal, removes an overhang.
And they're also proposing new projects in Maryland.
Yes, responding to the state's Next Generation Energy Act, they're proposing up to 800 megawatts of battery storage and about 700 megawatts of relocated low-carbon natural gas generation. It shows they're thinking broadly about energy solutions, not just nuclear.
Okay, one last piece of innovation. Demand response using AI.
Right. This is fascinating. They're building a large portfolio of AI-enabled demand response capacity. The goal is 1,000 megawatts under contract, 500 this year, 500 next.
1,000 megawatts is a lot of demand response. How significant is that?
It's huge. Management put it in perspective. In a market like TJM, 1,000 megawatts of reliable demand response provides the same capacity value to the grid as building a whole new nuclear power plant.
Wow. So effectively adding a virtual power plant without pouring any concrete.
Exactly. It helps grid stability, eases congestion, and it's another tool in their commercial offering. Very smart.
Okay, we've covered a lot. Operations, strategy, the data center boom, financials. Now for our favorite segment where we brainstorm potential ways to think about this. And let's be crystal clear. This is not financial advice, just exploring ideas.
Absolutely not advice. The big challenge with CE is, well, the stock's already had a monster run, up nearly 50% in a year, massively outpacing the utility sector ETF, XLU, which is up maybe 11%.
So the core story, nuclear powering the data economy, seems pretty well understood, maybe even priced in.
You could argue that, yeah. So if you're bullish, you're really betting on continued flawless execution and maybe some catalysts hitting sooner than expected.
Like the Calpine deal closing smoothly.
That's a big one. And maybe pulling forward the announcement of one of these huge hyperscaler power purchase agreements or PPAs.
So how could someone hypothetically structure a trade around that timing without just buying the stock at potentially elevated levels?
Well, you could look at options, specifically maybe something like a collar strategy. The idea is to use the current high implied volatility in the options market to your advantage.
Okay, walk me through that conceptually. A collar involves buying a put and selling a call, right?
Yeah.
But you're suggesting something slightly different.
Sort of a variation. You'd sell a near-dated, slightly out-of-the-money call option. You collect premium because volatility is high, lots of hype around potential deals right now.
Okay, selling the near-term hype. Then what?
Then you use that premium collected to help fund the purchase of longer-dated, maybe deep-in-the-money call options, perhaps targeting early Q1 2026.
Ah, so you sell the near-term call to buy a longer-term leveraged bet on the upside.
Precisely. You're essentially betting that the near-term expectations might be a bit frothy, or at least fully valued, but that the actual delivery smooth Calpine integration, a big PPA announcement maybe early next year, will provide a bigger, more tangible boost later on.
So you're leveraging the timing of those specific execution milestones. Calpine close, potential PPA deal, using options.
That's the idea. It's a way to express a very specific view on when the value gets unlocked, while trying to manage the cost given the stock's run-up. Again, purely hypothetical, not advice.
A complex idea for a complex situation. But it neatly ties back to what the market seemed to focus on this quarter, execution and timing.
I think that's the main takeaway. That small earnings miss, almost irrelevant in the grand scheme of this call. Investors look straight through it.
Their focus was squarely on the structural story. Constellation as this essential, reliable, clean energy provider for the data boom, underpinned by that incredibly well-run nuclear fleet.
Couldn't agree more.
So maybe a final thought to leave our listeners with. We talked about the land value, the irreplaceable nature of these nuclear sites. If building new nuclear is still so incredibly expensive and difficult, how much more premium should eventually be assigned to these existing sites? The ones that basically hold the keys, the land, the permits, the infrastructure, the talent for the next wave of clean power the U.S. needs. That underlying land value might be the ultimate sleeper asset here.
That's a great question to ponder, something beyond the quarterly numbers. Thanks for joining us for this deep dive.
We'll catch you on the next one.